Look at your screen. Look at the silver price. It says $75.47. You think that is the price of silver. You think that number represents reality. You're wrong. That number is a lie. While you're reading $75 on your American brokerage account, a factory owner in Shanghai is paying $80.23 for the exact same metal. While you're watching CNBC tell you silver is fairly valued, a refiner in Shenzhen is bidding $81 and still cannot get delivery. While you sleep, cargo planes are loading silver bars in London and flying them directly to Beijing. There's a $5 gap between what you pay and what China pays. This gap should not exist. In a functioning market, arbitrage traders would close it in seconds. Buy low in New York, sell high in Shanghai, pocket the difference. Simple. But the gap is not closing, it is widening. Today, January 7th, 2026, the Shanghai Premium hit its highest level in modern history. The spread between the Shanghai Gold Exchange and the COMEX has reached $5.76 per ounce. This is not a glitch. This is not a temporary dislocation. This is the financial system breaking in real time. In this 6-part investigation, we are going to expose the Shanghai vacuum. We are going to show you the mechanics of the greatest wealth transfer in human history. We are going to prove, with hard data, that China is systematically draining every ounce of silver from Western vaults. And we are going to explain why your screen price is not the real price. The real price is in Shanghai. The real price is $80 and rising. Let me show you what the mainstream financial media refuses to report. Every morning, the Shanghai Gold Exchange publishes the AM fix. This is the price at which physical silver actually changes hands in China. It is not a paper price. It is not a futures contract. It is the real price for real metal. This morning, the fix came in at $80.23 per ounce. Now look at your COMEX price. It says $75.47, subtract. That is a gap of $4.76 on the morning fix. By the afternoon session, the gap widened to $5.76. Why does this matter? Because silver is fungible. An ounce in New York is identical to an ounce in Shanghai. If there is a $5 difference, money will flow to exploit it. Traders will buy cheap metal in America and sell expensive metal in China. This creates a suction effect. The higher price in Shanghai acts like a vacuum cleaner. It sucks the metal out of every Western vault. London, New York, Zurich. Every bar that is not nailed down is being loaded onto planes and ships heading east. We have the shipping data, we have the vault reports, we have the customs declarations. The metal is moving, and it is not coming back. You might ask, why doesn't the arbitrage close the gap? Why doesn't the buying in New York push the price up to meet Shanghai? This is the critical question. This is where the manipulation becomes visible. The answer is paper. The COMEX price is not set by physical supply and demand. It is set by futures contracts, paper derivatives, digital promises. The banks can create unlimited paper contracts to suppress the price. They can sell silver they do not own to keep the price at $75, but they cannot ship paper to China. China demands physical metal, real bars, real weight. And the real market is telling us that physical silver is worth $80. The paper price is a fiction. The physical price is the truth. And right now, there's a $5 war between fiction and truth. This is not a small discrepancy. Let me put it in perspective. Silver trades approximately 800 million ounces per year. If the real price is $5 higher than the screen price, that represents a $4 billion annual transfer of wealth. $4 billion being stolen from Western silver holders every single year through price suppression. You are being robbed. The banks are keeping your asset artificially cheap so that China can buy it at a discount. Every ounce that leaves London at $75 and arrives in Shanghai at $80 represents a $5 gift to the East. This is the drain. This is the vacuum. And it is accelerating. Look at the trajectory. In 2023, the Shanghai Premium averaged $1.50. In 2024, it averaged $2.80. In 2025, it averaged $4.20. Now in January 2026, we are seeing $5 and higher. The gap is growing exponentially. This tells us that the hunger in China is increasing faster than the supply can satisfy it. The more metal that flows east, the more they want. It is not filling the hole, it is making the hole deeper. At some point, the Western vaults will be empty. The paper game will be exposed. The COMEX will default or cash settle. And when that happens, the price will not rise by $5. It will rise by $50. The Shanghai Premium is the early warning system. It is the smoke detector screaming before the house burns down. Most investors cannot hear it because the mainstream media has turned off the alarm. But you can hear it now. You can see the numbers. You can understand the mechanics. In part 2, we are going to walk through exactly how this drain works. We are going to follow a single bar of silver from a London vault to a Shanghai refinery. We are going to show you the arbitrage machine that runs 24 hours a day, eating the COMEX alive. And we are going to explain why the metal that leaves will never return. The vacuum is on, the drain is real, and your price is a lie. Most people think silver sits in a vault and stays there. They imagine stacks of bars behind thick steel doors untouched for decades. This is a fantasy. Silver flows like water. It moves constantly. It moves invisibly. And right now, it is flowing in one direction. East. In part 2 of this investigation, we are going to show you exactly how the drain works. We are going to trace the journey of a single silver bar from a London vault to a Shanghai factory. We are going to expose the arbitrage machine that is eating the Western financial system alive. Let us start with the math. The Shanghai Gold Exchange is quoting silver at $80.23. The COMEX in New York is quoting $75.47. That is a spread of $4.76. Now add the costs. Shipping a 1,000-ounce bar from London to Shanghai costs approximately $0.40 per ounce. Insurance costs $0.15. Financing and transaction fees add another $0.30. Total cost $0.85 per ounce. If you buy silver in London at $75.47, pay $0.85 to ship it, and sell it in Shanghai at $80.23, your profit is $3.91 per ounce, risk-free, guaranteed. On a single 1,000-ounce bar, that is $3,110 profit. Do you understand? Every single flight from London to Shanghai carrying silver generates millions in arbitrage profit. This is not speculation. This is mathematics. The arbitrage traders are not taking risk. They are exploiting a guaranteed spread created by the suppression of Western prices. The banks keep the COMEX cheap. The arbitrageurs buy cheap metal. They sell it to China at the real price. They pocket billions. This is why the drain cannot be stopped. As long as the spread exists, the arbitrage machine will run. It runs 24/7. It does not sleep. It does not care about fundamentals or sentiment. It cares only about the spread. Let me walk you through the chain of custody. It starts in a London vault. The London Bullion Market Association maintains massive underground vaults beneath the city. JP Morgan has one. HSBC has one. These vaults hold approximately 850 million ounces of silver on paper. But the actual allocation is murky. Much of this silver is leased, reapothecated, claimed by multiple parties. It is the same game the banks play with gold. They sell the same bar to 10 different investors. Now an arbitrageur enters the market. He buys 100,000 ounces on the LBMA at $75.50. He demands physical delivery. This is his right. He paid for the metal. He wants the bars. The bank scrambles. They have to find the physical silver to back the paper claim. They search the vault. They find the bars are already promised to someone else. They have to buy from a refiner. They have to lease from a central bank. They have to find real metal. This is the first point of stress. The demand for physical delivery exposes the fractional reserve nature of the paper market. There are more claims than bars, but the arbitrageur gets his metal. He arranges transport. A secure courier picks up the bars from the London vault. They are loaded into armored vehicles. They are driven to Heathrow Airport. They are loaded onto a cargo plane bound for Hong Kong. 14 hours later, the plane lands. The silver clears customs. It is trucked to a bonded warehouse. The next morning, it is delivered to the Shanghai Gold Exchange Depository. The arbitrageur sells the physical silver on the Shanghai Exchange at $23. He receives yuan. He converts to dollars. His profit is locked in. This entire process takes approximately 5 to 7 business days. In 1 week, the arbitrageur has generated $3.91 per ounce in risk-free profit. Annualized, this is a return of over 40%. Where on Wall Street can you get 40% risk-free returns? Nowhere. That is why the biggest traders in the world are doing this exact trade. They are draining London, they are draining New York, they are filling Shanghai. The numbers are staggering. According to shipping manifests and customs data, silver exports from the United Kingdom to China have increased 340% in the last 18 months. Hong Kong imports of silver have reached record highs. The Shanghai Gold Exchange Vault inventory has increased from 2,100 tons to 3,800 tons in 1 year. The metal is moving. It is not a theory, it is documented fact. But here is the critical point. The silver that goes to China does not come back. It is not sitting in a vault waiting to be re-exported. It is being consumed. It is being melted down and turned into solar panels. It is being fabricated into electronics. It is being absorbed into the industrial machine of the world's largest manufacturer. China produces 80% of the world's solar panels. Each gigawatt of solar capacity requires approximately 20 tons of silver. China added 280 gigawatts of solar in 2025. That is 5,600 tons of silver consumed in 1 year just for solar. The silver goes in. It does not come out. It is sequestered in panels that will sit on rooftops for 30 years. This is permanent demand. This is a black hole. The arbitrage machine is feeding the black hole. Every bar that leaves London makes the shortage worse. Every flight to Shanghai accelerates the drain. And the banks cannot stop it. They can suppress the paper price all they want, but they cannot stop the physical flow. The arbitrage is a mathematical certainty. In part 3, we are going to explain why China is willing to pay $80 when the screen says 75. We are going to look inside the factories of Jiangsu province. We are going to show you the industrial hunger that is driving this premium. And we are going to prove that the Shanghai price is not a bubble. It is the real clearing price for physical silver. The drain has a reason, the vacuum has a source. It is the insatiable demand of Chinese industry. You might look at the $5 premium and think China is overpaying. You might think it is speculation. You might think it is a bubble. You would be wrong. China is not overpaying for silver. China is paying the correct price, the real price, the price that reflects actual supply and demand for physical metal. It is the West that is underpaying. It is the COMEX that is broken. It is your screen that is lying. In part 3 of this investigation, we are going to explain why China is willing to pay $80 when New York says $75. We are going to take you inside the factories of Jiangsu and Zhejiang provinces. We are going to show you the industrial machine that is consuming silver faster than the world can mine it. The answer is not financial. It is physical. It is about real factories making real products that require real silver. And when a factory needs silver, it pays whatever the market demands. Let us start with solar. China dominates the global solar panel industry. They produce 80% of the world's photovoltaic cells. Names like LONGi, JA Solar, Trina, and Jinko are not familiar to Western investors, but they are the largest manufacturers on the planet. Every solar panel requires silver paste. The silver forms the conductive fingers that collect the electrical current generated by sunlight. Without silver, the panel does not work. There is no substitute at scale. The average solar panel uses approximately 20 milligrams of silver per watt. A typical residential panel is 400 watts. That is 8 grams of silver per panel. China produced 750 million solar panels in 2025. That is 6,000 tons of silver, just for solar, just in China, just in 1 year. Now consider the growth rate. Solar installations are increasing 25% per year globally. China is leading this expansion. Their factories are running at maximum capacity. They are building new production lines every month. When the factory manager at LONGi Solar needs silver paste for a production run, what does he do? He calls his supplier. He asks for 10 tons of silver. The supplier quotes him the Shanghai price, 80.23 suresh per ounce. Does the factory manager negotiate? Does he say, but the COMEX price is 75? No, because he needs the silver today. His production line cannot wait. If he does not secure the metal, the factory stops. Workers go home, orders are canceled, customers switch to competitors. The cost of not having silver is higher than the cost of silver. So he pays $80. He pays $82. He pays whatever it takes. This is what we call inelastic demand. The buyer is not price sensitive. The industrial necessity overrides the financial calculation. Now multiply this by 1,000 factories. Electronic manufacturers in Shenzhen need silver for contacts and switches. Battery producers in Ningde need silver zinc formulations. Medical device companies in Suzhou need silver for antimicrobial coatings. Automotive suppliers in Changchun need silver for every electrical connection in electric vehicles. The demand is relentless. It is structural. It is growing exponentially. But the supply is constrained. Global silver mine production has been flat at approximately 820 million ounces for the past 5 years. There are no major new mines coming online. The existing mines are depleting. Meanwhile, demand is increasing by 100 million ounces per year. Where does the extra metal come from? Recycling provides some, but most of the silver in solar panels and electronics is not economically recoverable. It is dispersed in tiny amounts across billions of devices. So the supply cannot meet the demand. The deficit must be filled from inventory. The vaults must be drained. This is what we are witnessing. The Shanghai premium is not irrational exuberance. It is the market screaming that there is not enough physical silver to satisfy industrial demand. Consider the strategic element. China understands that silver is critical to their technological future. They are building the energy infrastructure of the 21st century. Solar, batteries, electric vehicles, all of it requires silver. The Chinese government has designated silver as a strategic resource. They are stockpiling, they are hoarding, they are securing supply through long-term contracts with mining companies. They are buying every ounce that comes on the market. The official Chinese state reserves are not disclosed, but analysts estimate that the government holds between 5,000 and 15,000 tons of silver. This is separate from the industrial consumption. This is pure strategic accumulation. Why would a government pay $80 for silver when the Western price is $75? Because they are thinking in decades, not days. They know that the transition to renewable energy will require billions of ounces of silver. They know that controlling the supply means controlling the future. The $5 premium is not a cost. It is an investment. They are paying extra today to secure the metal they will need tomorrow. Meanwhile, the West is asleep. American investors look at the COMEX price and think silver is cheap. They do not see the physical shortage. They do not see the vault drainage. They do not see the industrial tsunami. The Shanghai premium is a signal. It is a flashing red warning light telling you that the physical market has disconnected from the paper market. The paper says $75. The physical says $80. Which one is real? The physical is always real. Paper's just a promise. And promises can be broken. In part 4, we are going to show you the vault crisis. We are going to analyze the inventory levels at the COMEX and the LBMA. We are going to prove that the registered silver available for delivery has fallen to critical levels. And we are going to explain what happens when the vault hits zero. The hunger in China is insatiable. The supply in the West is vanishing. Part 4 reveals the crisis inside the vault. Numbers do not lie, charts can be manipulated, headlines can be spun, but the vault reports are audited, the inventory is counted, and what the numbers show is terrifying. The COMEX registered silver inventory has fallen to 28.4 million ounces. This is the lowest level in modern history. This is the metal that is actually available for delivery against futures contracts. Let me put this in perspective. The daily trading volume on the COMEX silver futures market averages 350 million ounces of paper silver per day. The physical inventory backing those trades is 28.4 million ounces. That is a ratio of 12 to 1. For every ounce of real metal, there are 12 ounces of paper claims. If even 10% of contract holders demand physical delivery, the vault is empty. In part 4 of this investigation, we are going to analyze the COMEX vault crisis. We are going to show you the inventory drain in real time. We are going to explain the difference between registered and eligible silver, and we are going to reveal why the next delivery month could trigger a default. The COMEX reports 2 categories of silver, registered and eligible. Registered silver is metal that has been allocated to a specific warrant holder. It is available for delivery. It can be taken out of the vault. Eligible silver is metal that is stored in COMEX approved vaults but has not been registered for delivery. It is owned by someone, but it is not in the delivery pool. The distinction matters because eligible silver is not necessarily available. The owner might be a long-term holder. They might have no intention of selling. They might have already promised it to a Chinese buyer. When we look at registered silver, the number is stark. 28.4 million ounces. 1 year ago, it was 41 million. 2 years ago, it was 78 million. The registered inventory has fallen by 64% in 24 months. Where did it go? We know the answer. It went to Shanghai. It went to India. It went to the industrial consumers who pay the premium for physical metal. The drain rate is accelerating. In December 2025, registered inventory fell by 3.2 million ounces. In the first week of January 2026, another 1.8 million disappeared. At this rate, the registered inventory will hit zero in less than 4 months. Zero. No metal left for delivery. The vault is empty. What happens when the vault is empty? 2 possibilities. The first is default. The exchange cannot deliver the silver that contract holders have purchased. This triggers lawsuits. This triggers regulatory intervention. This destroys confidence in the entire futures market system. The second possibility is cash settlement. The exchange pays contract holders the cash value instead of delivering the metal. You wanted silver? Here's a check. Go find it yourself. Cash settlement sounds benign, but it is actually the worst outcome for price discovery. If the exchange can always settle in cash, there is no forcing mechanism to align the paper price with physical reality. They can keep the COMEX at $75 while the physical market trades at $100. Just pay the difference in cash. This breaks the market. It destroys the price signal. It transfers wealth from silver holders to the banks. We saw this exact scenario in the palladium market in 2019. The physical shortage became so acute that the NYMEX palladium contract went into persistent backwardation. Leasing rates spiked to 40% annualized. Eventually, the price doubled in 6 months to ration the remaining supply. Silver is following the same path. The backwardation is appearing. The nearby contracts are trading at a premium to the far month contracts. This is the physical market screaming for metal right now. Let us look at the LBMA. The London vaults are even more opaque. They do not publish daily inventory numbers like the COMEX, but they do publish monthly data. In November 2025, the LBMA reported total silver holdings of 842 million ounces. This sounds like a lot. But remember, much of this silver is encumbered. It is owned by ETFs like SLV. It is pledged as collateral for bank loans. It is double or triple claimed through the magic of rehypothecation. The float, the silver actually available for purchase and export, is a fraction of the headline number. Industry estimates suggest the true float is between 50 and 100 million ounces, and this float is evaporating. Every arbitrage trade that ships metal to Shanghai reduces the London float. Every ETF inflow that demands physical backing locks up inventory. Every industrial buyer who takes delivery removes metal from circulation. The LBMA publishes data on silver transfers. The average daily turnover is approximately 200 million ounces. But this is not physical movement. It is book entries. The same bars sold 5 times in a day without ever moving. It is paper shuffling. When someone actually demands physical delivery, the system strains. The metal has to be located. The claims have to be reconciled. The bar has to be transported. We are seeing increasing delivery delays. Bullion dealers report wait times of 4 to 6 weeks for large orders. In a normal market, delivery is 2 to 3 days. This stretched delivery time is evidence of shortage. The dealers will not admit it publicly, but privately, they are panicking. They cannot source the metal. Their suppliers are sold out. Their refiners have waiting lists. The retail market is a leading indicator. The U.S. Mint suspended production of American Silver Eagles multiple times in 2025 due to blank shortages. The Royal Canadian Mint has extended delivery times. Private mints are quoting 8-week lead times. If the mints cannot get blanks, if the dealers cannot get bars, if the vaults are draining at record pace, what does that tell you about the true state of the market? It tells you that the $75 price is a fantasy. It is a number generated by trading paper contracts that will never be delivered. The real price, the price to acquire actual metal, is $80 and rising. The vault crisis is the physical proof of the Shanghai premium. The gap exists because the metal does not. In Part 5, we are going to expose how the paper market maintains this illusion. We are going to explain how the banks use futures and options to suppress the price below physical reality. We are going to reveal the ETF loophole that creates phantom silver. And we are going to show you why the paper price must eventually snap to meet the physical price. The vaults are empty. The paper is worthless. The reckoning is coming. Part 5 strips away the illusion. You look at your screen. You see $75.47. You think this is the price of silver. But let me ask you a question. Can you buy physical silver at $75.47? Call your dealer. Ask for 100 and 100 ounces at spot. They will laugh at you. The premium over spot is $4 to $6 per ounce at retail. For larger quantities, the premium is $2 to $3. Even at the institutional level, the real transaction price is well above the COMEX quote. So what exactly is the COMEX price measuring? It is measuring the price of paper. It is measuring the price of a promise. It is measuring the price of a futures contract that 99% of traders will never take to delivery. In Part 5 of this investigation, we are going to expose the paper illusion. We are going to explain how the banks use derivatives to suppress the price below physical reality. We are going to reveal the naked short selling that has created more paper silver than physical silver exists. And we are going to show you why this illusion is breaking. The COMEX futures market was designed for hedging. Producers would sell futures to lock in prices. Consumers would buy futures to lock in costs. The contracts would be settled by delivery of physical metal. But over the decades, the market mutated. Financial speculators came to dominate. Banks discovered that they could sell unlimited paper contracts to control the price. The delivery mechanism withered. Less than 1% of contracts result in physical delivery. Today, the COMEX is not a physical market. It is a betting market. Traders are betting on the price direction. They are not buying silver, they are buying exposure to silver. When the contract expires, they roll it to the next month. The metal never changes hands. This creates an opportunity for manipulation. If the banks want to push the price down, they can sell massive quantities of paper contracts. There is no requirement that they own the silver. They are selling naked shorts. They are selling silver that does not exist. Look at the Commitment of Traders report. The 4 largest commercial traders hold a net short position of over 300 million ounces. 300 million ounces. The entire COMEX registered inventory is 28 million ounces. The banks are short 10 times more silver than exists in the vault. This is not hedging, this is manipulation. They are creating artificial supply by selling paper promises. Every paper contract they sell increases the supply of silver in the market. Basic economics says when supply increases, price decreases. So the banks can push the price down by selling unlimited paper. But there is a flaw in this scheme. Eventually, someone demands delivery. Eventually, the paper has to convert to physical. When that happens, the banks must source the metal. And if the metal does not exist, the game is over. This is what China is doing. They are buying futures contracts. They are demanding delivery. They are taking the metal to Shanghai. They are draining the vault, one contract at a time. The banks cannot stop them. Every delivery request exposes the fractional reserve nature of the system. Every bar that leaves reveals that the paper claims exceed the physical reality. Now let us look at the ETF market. The largest silver ETF is SLV, managed by BlackRock. It holds approximately 450 million ounces of silver according to its filings. This metal is stored in London vaults, primarily at JP Morgan. But here's the problem. The prospectus allows the custodian to use sub-custodians. These sub-custodians can further delegate to other parties. The chain of custody is murky. The actual location of the bars is not transparent. Moreover, authorized participants can create and redeem shares without immediate physical delivery. There is a settlement window. During this window, shares can exist without bars backing them. This creates phantom silver. During periods of high inflows, the ETF creates shares faster than it can source metal. The trust is temporarily unbacked. The authorized participants scramble to find bars. Sometimes they find them, sometimes they lease them, sometimes the accounting gets creative. We have seen periods where SLV inventory did not increase, despite massive share creation. We have seen delivery delays from the trust. We have seen discrepancies between reported holdings and physical audits. The ETF is not fully backed. It is fractionally reserved, just like the futures market. This matters because pension funds and institutions buy SLV thinking they own silver. They do not own silver. They own a claim on a claim on a claim. They own paper with a picture of a silver bar on it. When the physical shortage becomes acute, when the vaults are truly empty, these paper claims will be worthless. The ETF will suspend redemptions. The futures market will settle in cash. The investors will be left holding nothing. This is why the Shanghai premium is so important. China is not buying paper. China is buying physical. They are paying $80 because they are getting real metal. They do not trust the Western paper system. They have seen through the illusion. The smart money is following China. They are taking delivery. They are moving metal out of the system. They are converting paper claims into physical bars. The dumb money is still trading paper. They are buying SLV. They are rolling futures contracts. They think the screen price is real. When the illusion breaks, the transfer of wealth will be instantaneous. The paper holders will get cash settlements at $75. The physical holders will have metal worth $150. In the final part, part 6, we are going to give you the survival guide. We are going to tell you exactly how to position for the breaking of the paper market. We are going to reveal the exit strategy for converting your paper gains into permanent wealth. And we are going to show you the timeline for the next phase of this crisis. The screen is lying, the vault is empty, the reckoning is coming. Part 6 is the conclusion. We have shown you the $5 gap. We have explained the arbitrage drain. We have revealed the industrial hunger in China. We have exposed the vault crisis at the COMEX. We have stripped away the paper illusion. Now comes the most important part. What do you do about it? In this final section, part 6 of the Shanghai vacuum investigation, we are going to give you the survival guide. We are going to tell you exactly how to position your portfolio for the breaking of the paper market. We are going to explain when to hold paper and when to take delivery. And we are going to leave you with the exit strategy that converts temporary gains into permanent wealth. The first rule is simple. Understand what you own. If you own physical silver, bars, and coins in your possession or in an allocated vault, you are positioned correctly. You own real metal. The Shanghai premium proves that your metal is worth more than the screen price. You are holding dollars for 90 cents. Do not sell. If you own paper silver, futures contracts, ETF shares, mining stocks, you own a claim. This claim is valuable in a rising market, but it carries counterparty risk. If the system breaks, your paper could become worthless. The strategy is layered exposure. Keep a core position in physical metal. This is your insurance. This is your hedge against systemic failure. It should be 50% to 70% of your total silver allocation. Use paper instruments for trading gains. Buy calls when the technicals align. Trade the momentum. But take profits and convert them to physical. Every month you should be converting paper gains into physical metal. Buy a few ounces, buy a few bars. Increase your core position. The goal is to accumulate as much physical silver as possible while the paper price is suppressed. The Shanghai premium is your signal. When the premium widens, it means the physical shortage is intensifying. This is confirmation that your thesis is correct. When the premium narrows, it might mean supply is increasing temporarily. Use these signals to time your accumulation. Second rule, manage your leverage. In a parabolic move, volatility is deadly. We saw what happened on December 31st when the price crashed from $75 to $70. Leveraged traders got wiped out. They missed the entire recovery. If you are trading futures on margin, you are taking extreme risk. A 10% move against you can liquidate your entire position. And in a manipulated market, the banks will hunt your stops. They will engineer flash crashes to shake out the weak hands. The solution is to reduce leverage or eliminate it entirely. Own silver outright. Pay cash for your physical. Use options with defined risk instead of futures with unlimited liability. You want to be in a position where you can hold through a 20% drawdown without being forced to sell. The only way to ride this bull to 100 is to make sure you cannot be bucked off. Third rule, know your exit. And this is the hardest part. Silver is not a forever hold. At some point, you need to sell. But sell for what? Dollars? The dollar is the disease that silver is curing. The correct exit strategy is to swap silver for other hard assets at the right ratio. Watch the gold to silver ratio. Right now, it is approximately 58 to 1. Historically, this ratio has traded as low as 15 to 1. At 15 to 1, an ounce of gold is worth only 15 ounces of silver. At 58 to 1, an ounce of gold is worth 58 ounces of silver. Silver is cheap relative to gold. As the market reprices, silver will outperform. The ratio will fall. When the ratio hits 30 to 1, swap 30% of your silver for gold. You will be exchanging a volatile industrial commodity for a stable monetary metal. You will lock in gains. When the ratio hits 15 to 1, swap everything. You will triple your gold holdings compared to if you had just held gold from the start. This is how you exit, not into dollars, into permanent wealth. Fourth rule: ignore the noise. The next 6 months will be volatile. There will be days when silver drops 5%. There will be headlines screaming crash. There will be CNBC telling you to sell. Ignore all of it. The fundamentals have not changed. The Shanghai vacuum is still operating. The vaults are still draining. The industrial demand is still growing. Nothing that happens on a single day changes the multi-year trajectory. Your job is to zoom out. Look at the monthly chart. Look at the vault reports. Look at the Shanghai premium. As long as China is paying $80 and you're paying $75, the drain continues. As long as the registered inventory is falling, the squeeze continues. As long as the solar panel factories need silver, the demand continues. Do not let a red day shake you out of a green year. Fifth rule: spread the word. This information is not available on mainstream financial media. They do not report the Shanghai premium. They do not discuss the vault drain. They do not explain the paper manipulation. You have an advantage. You understand what is happening. You see through the illusion. Share this knowledge. Tell your family. Tell your friends. Send them this video. Build a community of people who understand the real silver market. When the repricing happens, when silver goes to $100 and beyond, the people who understood will prosper. The people who trusted the screen will suffer. You have the chance to help the people you care about. Final verdict: the Shanghai vacuum is real. The $5 gap between China and America is not a glitch. It is a feature of a broken system. China is paying the real price for physical silver. America is trading the fake price for paper promises. The arbitrage is draining every ounce from Western vaults. The metal is flowing east, and it will not return. The COMEX registered inventory has fallen to historic lows. The LBMA float is evaporating. The ETFs are fractionally reserved. The entire Western paper market is a house of cards built on a foundation of IOUs. When the vault hits zero, the cards collapse. The paper price will rocket to meet the physical price. The gap will close, but it will close upward. $75 will become $100, will become $150. You're standing at the beginning of the greatest wealth transfer in history. The transfer from paper to physical, from west to east, from the manipulators to the stackers. Do not blink, do not sell, do not believe the screen. The real price is in Shanghai. The real price is $80 and rising. And your silver is worth more than they tell you. Stack accordingly. Subscribe, share, prepare. The drain is real, the vacuum is on, and the repricing is coming.